Commencing on the 6th of January, a significant shift is scheduled to impact the financial landscape for 27 million hardworking employees in the United Kingdom. National Insurance (NI) contributions will be reduced substantially from 12% to a modest 10% on earnings that range between the bracket of £12,571 and £50,270. This considerable change essentially represents a substantial windfall worth a significant £450 per annum for those committed employees who earn an average full-time salary of £35,000. However, amidst this fluctuating financial landscape, the cumulative tax paid is escalating to unprecedented record-breaking levels as a result of a series of unyielding changes, which are not for those lacking fortitude. In an extraordinary, the government has fixed the threshold at which citizens start paying NI, £12,570, until the year 2028. As a result, as salaries gradually increase, a growing number of people will find themselves obliged NI, and income tax thresholds will similarly remain frozen until 2028. The tax-free personal allowance will persistently remain at £12,570, and the threshold that initiates higher tax rates will remain stagnant. Dramatic shifts and variations are anticipated to culminate in a remarkable increase of 3.2 million additional taxpayers by the year 2028, and a staggering 2.6 million more individuals will themselves subject to higher tax rates. This fiscal turbulence is projected to generate a substantial £25.5 billion more per annum by 2027 to 28 than if the NI and income tax thresholds had been adjusted in line with inflation. Individuals engaged in self-employment will also witness alterations to their national insurance payments commencing from the 6th of April 2024. They will be obliged to pay a rate of 8% on profits falling within the range of £12,571 and £50,270, a decrease from the current rate of 9%. Concurrently, on the same date, self-employed individuals will cease payment of a distinct category of national insurance, known as Class 2 contributions. The government asserts that this modification will lead to an annual saving averaging £192 for self-employed individuals. National insurance serves as the second largest source of revenue for the government, and its applicability extends throughout the United Kingdom. The eligibility for certain benefits, inclusive of the state pension, hinges on the total amount of national insurance contributions made. It is to be noted that individuals of or over the state pension age are exempt from making national insurance payments, regardless of their employment status. It is of significant importance to acknowledge that the income tax is applied to earnings derived from employment and self-employment profits, certain benefits and pensions, income from property rentals, and returns from savings and investments that exceed specified thresholds. The fundamental rate of income tax, set at 20%, is imposed on earnings ranging from £12,571 to £50,270 during the fiscal year. Meanwhile, the elevated rate of income tax, which stands at 40%, is applicable on earnings spanning from £50,271 to £125,140. Furthermore, the supplementary rate of income tax, established at 45%, is levied on all earnings in excess of £125,140 per annum. In a comprehensive view, the Office for Budget Responsibility, OBR, forecasts an ascent of taxes in each of the succeeding 5 years to a post-war pinnacle of 38% of GDP. This puts the United Kingdom at a median position within the G7 consortium of substantial economies. Transitioning from the predictions of tax, let us now direct our attention towards an integral element of the United Kingdom's economy, the Bank of England. Operating as the central banking institution of the United Kingdom, the Bank of England carries the imperative duty of issuing currency, orchestrating the nation's monetary policy, and safeguarding financial stability. Its role is inherently pivotal, functioning as the foundation of the United Kingdom's economic structure. The decisions it undertakes, be it the adjustment of interest rates, the implementation of quantitative easing, or the establishment of capital requirements for banks, exert a profound and wide-ranging impact on the United Kingdom's economy and financial markets. This influence extends beyond the confines of the United Kingdom. In fact, the policies and decisions of the Bank of England are scrutinized with great attention by economists and investors on a global scale, indicating the significance of its role in the worldwide economic scenario. Therefore, as we probe further into the complexities of the United Kingdom's financial forecast, it is essential to bear in mind the role and influence of the Bank of England. After all, it is not merely the government's decisions that mold the economy, but also the actions of this fundamental financial institution.